Good afternoon. I want to thank everybody for logging in and calling into our webinar today, in which we're going to talk specifically about using your IRA account as a private lender. And kind of an interesting way a lot of people invest their IRA accounts within a self-directed account instead of buying actual real estate is to use the IRA as a bank in certain situations and lending money to private individuals. So today's webinar will explore the rules that are involved with making those types of investments, and also the process that is involved in using your IRA in a lending capacity. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company for a little over 10 years. I've been doing a lot of, over my time at Advanta, done a lot of different transactions, worked with a lot of people on many different investments. Today's webinar, again, something I've seen quite a bit of, people investing their IRA in the form of a promissory note, maybe in the form of a mortgage loan. So we'll go through a lot of those different transactions. I think my background in that area really allows me to talk at a different level about this type of investment. But I've spent the last few years here at Advanta teaching classes, doing webinars like the one we're doing today, doing seminars as well. Now, as we go through the live webinar today, if you have questions that you'd like to ask during the webinar, please type that question into the chat box on your screen, and I'll make sure I get to those questions and get them answered. If you're somebody who's watching the recorded version of today's webinar, jot down your questions. My contact information will be at the end of the presentation. You can certainly give me a call or just give our office a call to get those particular questions answered. Now, one quick disclaimer on what we do, and I guess also what we don't do at Advanta IRA. We provide record-keeping services for people wanting to invest in alternative assets within an IRA account, but we are not. We don't give legal advice, tax advice, and certainly not any investment advice when it comes to making investments within a retirement account. So we'll talk about some legal issues today, maybe talk about some tax issues today, and even talk about some things you should consider before making an investment in a private loan. But ultimately, those determinations are all up to you with a self-directed IRA account and potentially some of your advisors as well. Now, we can refer you to attorneys or CPAs to help you make decisions, but it's not something we do at Advanta IRA. So we at least like to make that clear up front as far as what our role is. Now, we've been around since 2004, and the only thing that we do at Advanta, again, is the administration and record keeping for alternative investments within an IRA account. We have superior customer service that we offer to all of our clients. I think the signing up with Advanta, getting an account manager, one person who will work with you regarding your account, is a huge benefit to the people we've had that have signed up with us. Get a lot of feedback that they enjoy that experience, the fact that they're dealing with one person in our company, not calling simply an 800 number each time they need something regarding their account. Now, again, the only thing that we do is record keeping and administration for qualified money. We cannot hold any non-qualified money. Qualified funds would include IRAs, old employer plans like 401ks, 403bs, that type of funds. If you have personal savings accounts and you'd like us to handle that, that's just something we can't do. The money does have to be qualified. And again, the only thing we do is administration record keeping. We do not sell any investments at all. So why haven't people heard of self-directed IRA accounts? I think probably the biggest reason in general, before we get in really to talking about note investing, which is kind of a subset of this, just in general, people have not heard about or familiar with self-directed IRAs, mainly because their retirement accounts, their IRAs, their old 401ks, are with brokerage firms. They're with banks that are offering their clients limited investments, or at least they're limiting their clients to the investments that they sell at that particular firm, whether it's a CD at a bank, whether it's mutual funds or stocks at a brokerage firm. Their clients are limited to choosing from certain assets. So they're not making you aware of the fact that you could take this money, move it elsewhere, and like I said, invest in real estate, invest in private notes. So again, most people just aren't being, it's not being advertised to them, it's not being put out there by the company their funds are currently with. Therefore, they simply don't know it's possible. IRS regulations, though, do allow for a much broader range of investments, being able to invest into different types of real estate, different types of private placements. The IRS has very quick rules to understand, and we'll cover those today, on the things that you can't do within your IRA. So the IRS allows for a very, very broad range of investments, but they don't require each custodian, whether it's a company like Advanta or whether it's a Charles Schwab, they don't require each custodian to hold all of the potential investments. So each custodian can decide what they will hold. And again, a lot of the banks and brokerage firms simply decide to hold only those investments that they sell. Now again, in Advanta, we don't sell any products, we don't sell any investments, so we will allow you to hold any type of real estate, whether it's raw land, whether it's a residential condo, whether it's a residential single-family home, piece of commercial property, whether you're buying the property for long-term rents or whether you're buying it for a short-term flip, your IRA can make that investment and can hold that type of asset. Tied to real estate in a lot of respects, so the other investments we see quite a number of are in the form of what we call paper assets, and this will be largely the focus of our presentation today, is individuals using their IRA as a lending source. So instead of your IRA acquiring actual brick and mortar or dirt real estate and actually owning the actual physical asset, is having your IRA instead act as a financier and holding the note, holding the mortgage loan, the tax deeds, if you're lending money to a government basically to buy a unpaid tax bill. Really what we'll focus on today, and again, your IRA can deal and own a lot of these different types of assets, provided you're staying within the rules that we're going to discuss in a little bit. As far as other alternatives, we see a number of other different investments, whether it's in LLCs, investing into farm animals and partnerships, movie projects. Again, the list goes on of all the different possible investments you can make within a self-directed IRA account, whether it's a Forex trading account, whether you're buying a structured settlement. Again, just a lot of different possibilities because the rules the IRS has laid out for investing with your IRA account simply say there's a few things that you cannot do within your IRA. And again, we will discuss that here in just a few minutes. But again, a lot of the other alternatives we see are on this list as well. Oh, great. Question just popped up on the screen. I encourage you, again, as we go through the presentation, any questions you have, please get them up on the screen in the chat box and help drive the discussion. Question says, do we charge a transfer fee from wiring a large amount of cash into my established IRA with Advanta? Just to quickly cover our fees, we are a for-profit business, and we charge fees, though, that are based on our services, not commissions. We have a $50 one-time fee to open the account. We do not have a fee to transfer money in from an existing IRA or an existing account over into an Advanta account. Now, if you wire the money into us, there might be a small wire fee, but no fee just to move the cash into Advanta. We charge fees then based on the transactions. If you're making a loan, you're making a purchase of real estate, we have $100 or $150 or so charged to make that investment, and then we charge an annual maintenance fee. Generally speaking, it's $295 a year for each asset that we hold. But there's some other options. I would encourage the person asking the question, give me a call after the webinar. We'll go through your particular scenario. But again, there's only an initial setup fee. There is no fee to transfer money into Advanta unless you are having that money wired to us. So if you're looking to transfer or wire money into the account, kind of where can it come from? What types of accounts can I self-direct? Well, any type of IRA, whether it's a traditional or Roth, whether it's a SEP or a simple that you have for yourself as a small business owner or through an employer, a SEP and simple, those plans are usually for employers to set up. But any type of IRA, if you have an account statement from any brokerage firm or bank that has a designation of an IRA, that can certainly be transferred into a self-directed IRA and then in turn to use to make the investments that we're going to talk about today. We also offer solo 401k accounts for sole proprietors, people who own their own business, can establish their own 401k just for themselves. And also any former employer's plan. If you worked for a private company and had a 401k, or whether you worked for the school board of your town or your county and have a 403b plan, the 457s, pensions, etc. Any of those old employer plans can also be rolled over into a self-directed IRA account. The only accounts that you potentially are limited to moving would be any employer's plan that you have for someone who you are currently employed with. As long as you are currently employed, they can restrict your ability to move those funds. But as far as any former employer's plan, there is no restriction on moving and rolling that money over. Now, talk a little bit here, we'll get into more detail when we go through some of the transactions and some of the issues involved. We talk about private lending. We see a lot of different types of loans at Advanta. We see traditional mortgages where an IRA is lending money to a home buyer or somebody else, maybe another fellow investor who's just paying them on a traditional mortgage, 15, 20, 30-year mortgage, whatever the case may be. Or maybe it's a 5-year adjustable rate or a 5-year note with a balloon, but secured with a piece of real estate, kind of, again, what a bank would typically do in getting a mortgage to secure the loan they make to an individual, getting a mortgage on the property. The IRA can do the same thing. We've seen short-term loans, basically bridge loans, to help an individual close a transaction, have that money turned over fairly quickly, hopefully earn the IRA a few points for doing that particular loan. Unsecured notes. A little bit different, a little bit riskier type of an investment. Your IRA making a loan to a third party who signs a note promising to pay back your IRA according to the terms you've agreed upon, but they don't give you any collateral for it. Okay, there is no piece of real estate that you can take back in the event that loan isn't paid. So again, those are allowable. It's a type of lending. Just again, it's whether or not you have the comfort level to make that particular investment. We also have seen people do equity participation in joint venture agreements where instead of forming a partnership, if I had money in my IRA and a buddy of mine is going to rehab houses, we could form some type of LLC structure and join our money together that way and split the profits. Or I could lend money to him in the form of a mortgage loan and have it written out in the note that I can, we'll share a portion of the profits after the fact. And then you also can secure notes. I mean, a lot of the secured notes that we have at Advanta, and I think probably held in a lot of self-directed IRAs, are mortgages where the security for the note is a piece of real estate. But it certainly is possible for a borrower to put up other types of collateral like farm equipment, automobiles, livestock, etc., to actually secure payment of that particular loan. Okay, we're going to go into kind of what the prohibited investments are. We have another question come up, and again, if you have questions, please type those in. Said, I see that it's feasible to have a Forex account, but what about regular equity stock trading or options? With a self-directed IRA, you really don't need a self-directed IRA if you were trading in a regular stock account or an options account you could have with a Fidelity or a Schwab or an E-Trade or someone like that. So typically speaking, we don't hold those types of accounts here at Advanta because it doesn't make sense for you to open up an IRA with us for us to then in turn open up a trading account at E-Trade when you could simply go to E-Trade and open up an IRA account there. But when you get into Forex and commodity trading accounts, those brokerage firms won't handle those types of trades. They don't have a platform to be able to trade Forex, to trade on the commodities. Generally speaking, that is why people use in a self-directed IRA to buy that type of asset. So I hope I answered your question. Again, if not, please contact me afterwards. But again, we're talking about investments. There's a whole litany of things that we talk about you can do as far as real estate, private notes, mortgages, private LLCs, and obviously the stocks and bonds and mutual funds that we're familiar with. Again, when the IRS created IRA accounts, they simply decided to say there's a few things that you cannot do with your IRA account. There's a few investments and a few people that you cannot transact with. So rather than trying to foresee all the potential investments that someone could make, the IRS simply said you cannot invest your IRA into life insurance, and you cannot invest your IRA into collectibles. Collectibles would include antiques, coins, artwork, alcohol, things of that nature. So those are the only two prohibited investments that you cannot make within an IRA account. Now, the other restriction the IRS places, though, that we'll deal with a little bit more when we talk about transactions and who you can lend to, is the IRS said there are certain disqualified persons who cannot transact with your IRA account. Okay, so your IRA is its own separate legal entity, and as such, your IRA cannot transact with you personally as the IRA owner, or your spouse, your parents and grandparents, if it's your IRA, or your children and grandchildren. They also then included any spouse of a lineal descendant. So, for instance, context of today's presentation, you can't lend money to yourself from your IRA. Your IRA cannot lend money to your spouse. Your IRA cannot lend money to your parents or your grandparents. Your IRA cannot lend money to your son or your daughter. And you cannot lend money from your IRA to your son-in-law or daughter-in-law because they're also a spouse. And then they also include any business or entity that are controlled by any of those people as well. So again, your son has his own business. Your IRA can't lend money to his business. So again, there's certain people, there's the disqualified investments of collectibles and life insurance, but practically speaking, we deal more so with questions on who your IRA is in turn lending to, or maybe who your IRA is dealing with. So these are the certain disqualified persons who cannot transact with your IRA account. So a prohibited transaction from an IRS perspective involves your IRA, a disqualified person, and then a transaction going on between the two. So again, talking about lending, your IRA lending to one of those parties, or possibly one of those parties lending to your IRA. It's a little rare that we get that question, but that's what involves in the transaction. Your IRA is a lender, and somebody is a disqualified person as a borrower. It's going to be prohibited. There is no exception to that rule. So if you wanted to lend money to your son, and your son had recently gone to his local bank, and they were willing to lend him money under certain terms, your IRA can't simply match those terms and say, hey, this is a fair market transaction. Bank of America, Wells Fargo is going to do it at this rate. It's simply no caveats to that rule. There is no exception for your IRA transacting with somebody who's disqualified. Now, some other things to think about when you talk about prohibited transactions. Brothers and sisters and other family members are not technically disqualified. Your sister, your cousin, your aunt, uncle, niece, nephew are not actually disqualified persons under the rules. However, if you are going to deal with one of those individuals for terms or under a scenario that is probably considered less than fair market value, you could invite IRS scrutiny into that transaction and have them level the charge that this is a prohibited transaction. In addition to your IRA not being able to transact with disqualified persons, no disqualified person should receive any type of benefit from the investments held in your account. What I mean by that is, let's take your sister or your brother, for example, a sibling. Your IRA wants to lend money to that particular individual. Okay, under the rules, they are not disqualified. However, you lend them money at a rate which is less than what you would typically lend to any other individual. So, your sister goes to get a loan, the bank's going to charge her 6 or 7%. You decide to do the loan for 2 or 3 to help her out. Now you are benefiting personally, and you are a disqualified person. You are benefiting. You're doing something nice. You feel good about what you did. So for that reason, if you're going to deal with those types of family members, we encourage you to do it for at least a fair market value, arm's length basis. And ultimately, it's going to be up to you to determine what those terms are and make sure you're meeting that threshold. Also, using a middleman between your IRA and a disqualified person is also considered prohibited. It's called a step transaction. This would involve, say, my IRA account wants to lend money to my son. And of course, we just said that's against the rules for me to do that. So instead, I have my IRA make a loan to a friend of mine. My friend of mine then in turn makes the loan to my son. Sounds like that should be prohibited because it is. The IRS would say, just because you put somebody in between and you create an extra step, it's still going to be a prohibited transaction. That's what the step transaction doctrine is. So it can't simply substitute somebody in the middle and make the investment legal. Another consideration: if if you have person A lending the money from their IRA to person B, and then have person B using their IRA to lend back to person A, the IRS could potentially look at that as prohibited depending on the circumstance. Okay, if a buddy of mine, my buddy and my friend of mine and myself each have $20,000 in our IRA account. Both of us would like to take that money out without paying taxes or penalties, but we're under 59.5, so we're going to have a penalty. We're going to have taxes on top of that. So we devised a scheme by which I can lend my $20,000 to him. He can lend his $20,000 to me, and we do that transaction to avoid paying any taxes or penalties on taking a distribution by using each other. I would think, again, that'd be a scenario where the IRS would say that could very well be prohibited, that your goal in lending money from your IRA to your friend and vice versa was to escape taxes and penalties. They would consider that potentially to be a prohibited transaction. You change that scenario a little bit where my friend of mine rehabs houses, and I rehab houses, and from time to time we're always looking for additional capital. I don't know that my IRA lending to him on his deal, I don't think that would then prohibit him from down the line lending money from his IRA to me on the subsequent deal. So I hope kind of everybody understood a little bit there. Last consideration, just something to think about. And this stems from a real-life case study that we had here at Advanta. Would your IRA be allowed to lend money to a borrower, a third party, and have that promissory note have security be a collectible? Again, collectibles are prohibited for your IRA to hold inside the account. But if your IRA is simply lending money to somebody and the security is a collectible, is that prohibited? We at Advanta determined for our client that it was up to them to make that determination, because ultimately the IRA is lending money. The investment the IRA makes is in a note to a third party. That is not prohibited. What the client was faced with was what happens if that borrower doesn't pay. Because in that scenario, your IRA would be prohibited from taking and seizing that collectible as not, basically as the security for that particular loan. So the IRA could not repossess that particular collectible. The reason we allowed this transaction, allowed the client to sign off on a waiver to do it, is what client would have the ability, if the note became due and payable and borrower was in default, is the IRA could sell that note and assign its rights in that note to some other third party who could then in turn seize the collectible. But if you're going to make that investment, again, the client had to understand that their only avenue would be to sell their rights in the note. They could not collect or basically the repossess that particular asset. So again, just something else to think about, again, when you're talking about prohibited transactions. Another question came up, says, if we can't remember all these rules, can we contact Advanta to ask if a transaction we're considering would be legal? The answer is yes. You can certainly call us at any point to ask us for our input. Now, at times, when it comes to certain transactions, if it's in a gray area of the law, we cannot make a determination for you whether or not it is legal or not. That is up to you or an attorney. We can certainly, though, go over the rules with you. And if you present us with a scenario, we can tell you where we see potential issues in that particular scenario and let you then make a better, more educated decision. My only advice in this area would be, if you're thinking about doing the transaction and you have questions on it, please do call us in advance. Do not do the transaction and call us later and ask, do you think this was okay for me to do? But certainly, you have an account manager here at Advanta. Always contact myself if you have questions about these types of transactions, and we'll give you our feedback from there. So getting away from the rules, why do people look to invest in private loans? Again, some of the common threads, the things we've seen over the years at Advanta, one, a lot of people choose to self-direct simply because they want to get away from the stock market. Okay, they want to get away from the roller coaster. They want to get in an investment that they feel safer in. Basically, investing in a private loan with a sufficient down payment, where the borrower has enough equity, that sounds like a safer investment to a lot of people than so does putting your money and trusting it in the stock market. But as far as private lending specifically, as opposed to just self-direction in general, a lot of people like the ability to act as a bank and set the terms at which their IRA is going to grow. When you agree to lend money out of your IRA at 10% or at 8% or whatever the case may be, that loan's paying off. You know exactly what your IRA is growing at on an annual basis. When we talk about owning real estate directly in the IRA, you might have some liability concerns. Whether your IRA owns a piece of property and someone slips and falls, they may be able to come after your IRA for any judgment if there was a negligent condition or something otherwise on that particular property. But no one ever sues a bank. Again, if you're slip and fall on someone's property, you sue the homeowner. You don't sue the actual bank holding the mortgage. So for some, they would rather own private notes in their IRA account rather than real estate. So if there was ever any type of lawsuit, their IRA would not be liable for any particular damages. So for some, it's a liability issue. That being said, a lot of our clients own real estate directly in their IRA accounts and properly insure the real estate. They properly get LLCs, other types of trusts, other types of structures involved to help limit their liability there as well. So don't be afraid necessarily to buy real estate in your IRA. But why people do private loans is they want to remove the issue of that liability. It's also a very low maintenance asset. When you compare it to owning real estate where you have rents coming in, you have bills being paid out, tenants to manage, and keeping track of all that, a little bit more involved. Maybe a better chance for some more gain within your IRA, maybe a better reward at the end for doing some of that work. But for private loans, you simply need to make sure you're getting paid back every month or every quarter, how often your borrower is to make payments. Now, when you're making terms and you're establishing a note or a mortgage with your IRA account, you get, again, to sit as a bank and decide what terms you're going to lend money on. Now, if you out of your IRA. Now, if you went to a bank today, anyone on the call or anyone listening to the recording goes to a bank after viewing this presentation and sits down and asks for a loan, okay, the bank is going to run your credit. They're going to look at what collateral you have to offer, and they're going to tell you then, based on the information they've gathered, what terms at which, how much money they're going to actually lend you, what the interest rate might be, when the maturity date is, when they want to be fully paid back. What is is there any prepayment penalties? Is it amortized, etc.? So we would all expect that when we go sit at a bank that we're going to be told these terms, and then decide from there whether or not we want to borrow the funds from that institution. So when it comes to your IRA and someone is borrowing money from you or wants to borrow money from you, you get to sit in that same role and decide which of these terms you're going to put into your note, what those terms will actually be. So again, that's something that's attractive to individuals wanting to do private lending out of your IRA, is to be able to sit there and dictate those terms. Now again, you may dictate the terms, you may be more willing to work with your borrower and coming up with a payment plan, an interest rate, et cetera, an agreement that works for both parties. But ultimately, it's your IRA, and you get to decide what terms are going to be involved in that particular loan. So what I would plan to do now is go through some case studies to show you, A, how the process works, and then also, B, to illustrate and bring out a few more of the issues that we've already talked about. Again, as we go forward, you have additional questions, please type them into the chat box on the screen. Now, in the first case study, pretty straightforward. We have an individual who has money in his IRA, just looking for better returns from his account. Doesn't like where his money is invested. After doing research, maybe he attends a lunch and learn or one of our webinars like we're doing today, realizes that he, Paul, can lend money out of his IRA in the form of a private mortgage loan and have that loan secured by a piece of real estate, get better returns. He works with a local mortgage broker to lend money to the particular borrowers. He's going to have that loan secured, again, by a first mortgage. Here are the loan terms that Paul agrees to with his borrower. And again, these are the terms that one client did. This is not, obviously, it doesn't have to be the terms you would decide. You might decide, instead of having a 7% interest rate, I'll take 8% or I'll take 10 and I'll amortize it out over 15 or 20 years, have payments come in that way. But regardless, the terms that go into this particular note are between Paul and between the borrower to set what is acceptable to each of them. Now, the steps in the process. So Paul decides, I want to make this mortgage loan. I want to do private lending with my IRA. How do I start? What's my first step? Well, the first step for Paul would be to contact our office, get the paperwork to actually open up and form his Advance IRA account. So he's going to fill out our application documents, and within that package is the paperwork to send to his current IRA administrator or to his old 401k administrator to get that process started to then fund his particular IRA, either by a transfer or a rollover. Both the ways of moving those funds are non-taxable events. So Paul's $120,000 he's moving over, not going to be taxable to him at all to move that money to us, and certainly not to make the investment as well. So the first step was getting his account open, getting it funded. The next step, Paul is going to find that particular loan. And maybe he already found it before he came to Advanta, but either way, he's going to find the loan, figure out what the terms are going to be, and then tell Advanta. He's going to contact his account manager and tell them, I'm going to make a $120,000 loan at 7%. Here's the title company. Here's the attorney that is handling that particular closing. We will then work with the closing agent to make sure that the loan documents, the note, the mortgage, properly show Paul's IRA as the lender, make sure that the terms in that note match what Paul has told us the terms will be. And once we've okayed those documents, we will ultimately send them back to Paul to make sure he reviews the legalese in the documents, and again, accepting of the loan, he will initial off that he has read and approved each page of that note and mortgage, basically giving us approval and giving us confirmation that he wants to go forward with this investment. At that point, our job is we will wire the money to the title company or to the attorney involved in the closing. And then the mortgage gets recorded, and once the mortgage is recorded, that document and the original note are sent to Advanta for safekeeping. So his investment has now been made. His IRA has stood in the place of a bank and lent money to that third party. And then the purchase is completed. Now going forward, his borrower will send their monthly payment, whether it's interest only or whether it's amortized, to Advanta. We will receive and deposit that money into his account. And Paul can track his account track those payments using our online statements, so he can log into his account at any point and view the funds coming in. Or our system will also send Paul an automatic email whenever we receive and deposit funds into his account as well. So he has kind of two ways to track those payments. And ultimately, the funds come back in. We're receiving all the interest payments tax-free back to his IRA. There's no tax event for that money coming back into his IRA. And ultimately, when that property is sold, he has the first mortgage. So the new buyer of the house will have to satisfy that mortgage by paying that money from the new sale of the property to pay off his existing mortgage. So he was able to return both income generated from each payments back into his IRA, and also the money is coming back at the end from the sale of the property. All go back into his IRA, again tax-free or tax-deferred. All right, I had another question pop up on our chat box. Does Advanta introduce us IRA investors to possible loan or mortgage opportunities, or alternatively, where can we find those? Again, one thing we don't do at Advanta is we don't try to put people together. We don't try to put deals together. We don't try to again, we're not selling anybody on any particular investment. What we can do in the mortgage realm is possibly let you know of some private money deal brokers, companies that have worked with some of our clients in the past, where you can contact them. They may then be able to help set you up in a loan, or at least get some information from you. We will usually give you a few names. We don't endorse anyone in particularly. We can give you a couple names to let you do your own investigation. The other area where you could find out more about opportunities would be going to real estate investment clubs. There's a lot of different meetings. Some of them are smaller, some of them are larger, some of them meet weekly, some of them meet monthly. But going to those opportunities and doing some networking, you will certainly, if you would, for instance, you ever announce yourself as a private lender at one of those events, you will be immediately surrounded probably and presented with multiple opportunities. But again, it's up to you to do your due diligence on the mortgage broker you're working with or your particular borrower as well. So again, that's just something to encourage you. You can certainly find those opportunities, but we, again, cannot introduce you to a particular loan or particular borrower. It's one thing that we don't do. And also for the protection of our clients, we do get calls quite often from people wanting to sell their investments to our clients. Is how can I get a list of your database? You must have clients who have money in their IRAs that are willing to lend, and that's not something that we do. So we protect our clients from those types of loans as well. So it's kind of where it works kind of as an account holder. We're not going to put you in touch with somebody, but we're also not going to put anybody in touch with you to solicit to you from a particular investment. All right, moving along to the next case study. A lot of the loans we see at Advanta are kind of just a term, what you would think of as a traditional loan, where your IRA lends money, you agree on an interest rate, the person pays you back in a timely manner every month, every quarter, etc. But kind of another interesting investment we see from time to time is where people structure their loan as an equity participation vehicle. And this, again, is going to happen in instances where your IRA is lending money to a real estate investor, someone who's going to take your capital from your IRA and use it to go buy a rental property or use it to go buy a rehab project. And so what, in this case, Andrea was looking to do was to lend money to somebody, but she wanted to share in the profits. She didn't simply want to agree on an interest rate and sit back and get 7 or 8%. She saw an opportunity to get a little bit of the upside from what the particular people, in this case Steve, who's looking to rehab a property. She knows Steve does well, and he oftentimes makes a good deal of money on his flips. She says, hey, I can loan money to Steve, but I don't want just 6% or 7%. I want a portion of his profit. So again, important thing when you're looking to loan money out of your IRA, again, Advanta doesn't do due diligence on investments, so it's up to the client to do her due diligence not only on Steve, obviously she's lending the money to him, wants to know if he's a good or bad actor, but also on the property that he's going to flip. Steve says, if you lend me $100,000, I can acquire this property, get it fixed, and I can get it sold for a profit. She's going to want to kind of probably look at that property and make sure that he's actually, what he's saying to her is realistic. That's something that might actually occur. So Andrea is going to perform that due diligence on the individual and on the property that he's going to buy, and ultimately offers to lend him the $100,000 to flip the property. Now again, the clients we've had that have done equity participation and joint venture agreements, obviously structure a little bit differently. Now most private loans for rehabbers, people who are looking to borrow hard money in the form of a loan, is the interest rate usually is probably between 10 and 12%. That's something they're usually accustomed to paying. But in this case, this particular client offered her borrower 5% as an interest rate, so a much lower interest rate, but asked for a third of the profit. They split the profits, whatever amount over and above the $100,000 that he was lent. Steve has to give her IRA 1/3 of the profits over and above that. Now, obviously, you can move those terms around. You can define profits in different ways as well. But she also got a first mortgage on the property, so if Steve can't pay her back, ultimately she can foreclose and take back the property and recoup some part of her investment. Andrea has her attorney prepare the note and mortgage. She reviews and approves all the documents, the note, the mortgage, title policies, etc. Ultimately, we then fund the note, and when the note gets paid off, and Steve is ready to sell that property in a few months, Andrea is going to help prepare the payoff amount, figure out what exactly is Steve going to have to pay on that loan to satisfy that note and mortgage and clear the property. Ultimately, the $130,000 closing, purchase price for the new buyer, her IRA gets back its initial principal. It got 6 months of payments back into the IRA, and she also gets that percentage of profit. So her IRA ends up returning over $12,000 on her $100,000 investment by structuring the deal in a way to bring in some of the equity participation or some joint venturing as well. And from Steve's perspective, Steve was able to borrow money from an IRA, pay it back, and still make a profit himself. And I include this slide to illustrate that knowing about self-directed IRAs and wanting to use IRAs to make investments is not something that only people with IRAs should understand and take into consideration. In this instance, and it happens with some of our clients, Steve is a borrower. Steve does not have an IRA. Steve does not have a retirement account. So why would he ever care what a self-directed IRA is? Well, here's exactly why. Because if he's going out to look for money, he's going out to solicit for, ask people to loan him money, by knowing about self-directed IRAs, he may unlock more money that he would have access to. If he'd gone to Andrea and said, I need to borrow $100,000 for an upcoming project, are you interested? And she just looks in her checking account and says, nope, sorry, don't have $100,000 laying around, I can't help you. Steve knows about self-direction, says, well, I know you don't have maybe any money in your checking account. Do you have any retirement accounts? Do you have any IRAs or 401ks that might be eligible? Andrea may not have ever even thought about that as a possibility and said, I didn't think you could do that. So Steve's knowledge of self-direction and what you can do ultimately can benefit him at the end, even if he doesn't have his own account. just some notes. Now, again, the two examples we've gone through so far is real estate being used as the collateral for the particular loan. But what about using things other than real estate? What are some pitfalls that you want to make sure you're aware of? Now, again, we talked about having your note secured by a prohibited investment like life insurance or collectible. It's not per se prohibited. It's not against the rules because your IRA is simply lending money to a third party. It's a loan, but it could make collection difficult. Ultimately, that person doesn't pay, that borrower doesn't pay. The only option your IRA would have would be to basically sell that note to a third party. Additionally, if you lend money to a company, this is something else we've seen many times over the years, having an IRA lend money to a private company, and in the terms of the note, the company has the right or the ability that instead of paying off the note with cash, the company can satisfy the note by simply issuing stock to the IRA. So the IRA lends money to a company. The company then says, we're not going to pay you back, but your IRA is now going to be a shareholder in the company. So you exchange the note for shares of stock. Be very careful about the type of entity that you are lending money to. If you are lending money to an S corporation and they're promising you stock in lieu of paying back your loan, that's not necessarily a good deal for you, because S corporations cannot have IRAs as shareholders. It's against S corporation rules for your IRA to be a shareholder. So if you enter in that type of a loan, you have to bank on the S corp simply paying you back. Also, if you lend your IRA, lends money to a partnership and the partnership gives you stock back, you also may subject your IRA to a tax if that partnership, if your IRA becomes an owner in the partnership, and ultimately the IRA is getting back business profit. Lastly, the last kind of consideration to think about, what would you use as a security agreement? And how would you record it? And how would you put people on notice? If you lend money from your IRA and secure that loan with a mortgage, and someone tries to buy that piece of real estate from the owner of the property, a proper title search will indicate that your IRA has a mortgage on that property that must first be satisfied before a buyer can come in. That's what mortgages are, a safer form of lending, because you have that security that the loan, the asset's simply not going to be sold out from underneath you. But if you're not using real estate and you're using a car, or you're using equipment, for instance, to secure that loan, how are you going to put other people on notice that if they were to buy that car or to buy that other equipment from the person, that they first need to satisfy your debt? So a lot of people have used UCC filings, done other types. Obviously, cars you can get a lien on a car title, maybe a bad example there. But other types of interesting assets, how would you put people on notice that you have an interest in that particular asset? So just, again, something different when you're not using real estate as the collateral, something else you need to consider. Now, we had another question just pop up. It says, after finding a borrower, who do we contact first to get the ball rolling, the attorney or a title company? I would say the first thing, if you have an IRA with us, or you're looking to start one, and you identify someone as a borrower, the first step would probably be to give us a call. Call your account manager here at Advanta. Let them know, hey, I found a borrower. We've agreed on some terms. And then let us know who the attorney or the title company is that's going to ultimately handle that particular transaction. If we're lending money on a mortgage loan and they're going to be acting as an escrow agent, let us know who that is. And we will then contact the attorney and the title company to let them know how the documents need to be titled. So you can certainly get us on the phone with them. I think that'd be the first contact, just so we can start the process, and also let you know exactly what that process will be. After we contact the title company and give them the wording, we will wait for the documents to come back from them. So they will prepare the note and the mortgage. Ultimately, we will send those documents to you then for approval. So I would contact Advanta first once you identify that loan you wish to make. We will let you then know what the next steps of that process will be. Now, if you're going to have an attorney draft your note, certainly put us in touch with them as well. Next example, we have Tom has some money in an IRA account, and he wants to lend money to a friend. Okay, his friend's starting up a new business. It's a good business plan, good business idea, but he needs some other additional capital just on a short-term basis. But Tom he's willing to do this loan with his friend, but the friend can't really put up any collateral. Okay, so he doesn't have a property that he can put up as a mortgage or any other assets to give Tom any security for the loan. But Tom decides, I know this person, I've known him my whole life. He's a good guy. His business plan is rock solid. He's going to have no problem paying me back. And I don't want to go through the process of having him trying to find assets to use as security for the loan. So Tom agrees to lend money out of his SEP account without any type of collateral on an unsecured basis. So he lends his friend $50,000, gets 10% down. Charges him 10% interest rate with a one-year balloon. So at the end of the year, his friend will simply make a one-time payment of $55,000 back into Tom's IRA. Now, the purpose of this example is to illustrate two things. One, obviously the loan doesn't have to have security. Tom can make this investment. He doesn't have to have a mortgage. He doesn't have to have any other type of assets as security. Might be advisable, might be something you or I would want to insist on, but it's not required. So you can certainly do an unsecured loans. They are allowable underneath the IRS rules as long as, again, the person on the other side is not disqualified. The other thing, just to illustrate again, are the terms involved. Now, the other two loans that we talked about previously had monthly payments, where the borrower was making a monthly payment back into the IRA. Ultimately, when the property sold, they got paid off. But in this case, Tom decides, I'll just do a one-year balloon. I don't need monthly payments. I don't need payments throughout the year, but I do want the full payment at the later date. So again, that is possible and legal to determine those particular terms. And just again, some special considerations when we talk about unsecured notes. With an unsecured note, there is no title company. There is no attorney involved in handling the deal. So before we will issue money out of your account for that loan, we do want the original note in our possession before funding. If we are funding a note or a mortgage through a title company or an attorney, they will make sure that the documents get appropriately signed before they close out escrow and release funds. But in this case, since we're releasing funds directly to the borrower, we do need the original note in our possession. You're also going to probably have a little bit higher interest rate, okay, than conventional. Unsecured loans generally, they're going to be riskier than a secured loan. Therefore, the rate tends to be a little bit higher. And also, please make sure that you know who your borrower is. Make sure you're comfortable with who you're lending to. Be very difficult to recover on an unsecured note in the event that it's not paid. If your borrower were to stop paying and default on the loan, and you file a lawsuit against them and they declare bankruptcy, your IRA with its unsecured note will be at the end of the line for recovering against that borrower. So please make sure you know who you're dealing with. Again, not a job of Advances to figure out if this is somebody you should be lending on an unsecured basis to. Now, before we go to the last case study, we have another question pop up. Assume that I have a normal real estate IRA with Advances. You'll charge our $295 a year asset in the IRA. Now assume that I have a checkbook IRA. Will I be charged the same amount each year for each asset since I am more in control? That's something that is outside of the presentation we're doing today when talking about checkbook control, where you can set up an LLC for your IRA to simply own the LLC. And your LLC then goes and buys real estate and buys other investments. Now, just to answer the question very quickly, if you have a checkbook IRA, we charge $295 a year just to hold that LLC interest. Now, if your LLC buys multiple properties or makes multiple loans from that LLC account, we do not charge anything over and above the $295. It's only one flat $295 a year fee for the LLC. It does not matter how many assets the LLC owns. But again, that's a question I'd be happy to take with you offline and go over your specific scenario and give you the details. But that is one advantage that the checkbook IRA has in setting up that LLC, is that you don't have to pay us a fee for each different asset you buy underneath that umbrella. Now, to go with our last case study as we wrap up the webinar today, talk about a little bit different scenario. Someone using their IRA to acquire real estate, to actually go out and buy a piece of property, but then when they go to sell it, they hold back, they do what they call a carryback note or seller finance the purchase to their end user. So kind of how this transaction's worked out, this is again based on an actual client we had who bought several properties at foreclosure auctions, got them at very good deals. So in this case, Jim, the name's been changed, but Jim bought a property at foreclosure for 40 grand, used $10,000 from his IRA to get that property fixed up, and then he was looking then to resell it, basically to rehab the house and sell it to an end buyer. But instead of, one option he'd certainly have is he rehabs the house, buys it for 40, puts 10 into it, rehabs it, finds an end buyer who just simply pays him the $80,000 cash. That cash goes back to his IRA and he moves on to the next deal. But this particular client wasn't interested in simply getting the cash back. He was looking for other investments that would give him additional yield. So he actually would sell these properties at a profit, but he would finance part of that purchase price in his IRA for that end buyer. So in his terms, he would basically lending money from his IRA at $70,000 at 8% with a 15-year amortized loan, and got these monthly payments back into his IRA account. He would actually ask for and require a portion of a down payment. So he, again, bought the property for 40, put $10,000 into it. He had $50,000 invested in the property. He sold it for $80,000, but that sale was basically the new buyer / borrower giving him $10,000 up front, and then instead signing a note and mortgage to his IRA to pay the remaining $70,000. And this was this client's strategy, were to acquire numerous properties in his IRA and simply sell them off in exchange for holding mortgages that would return that 8-9% back into his account. So how this deal worked, Jim, again the client, opened up his account, funded it by doing a transfer or rollover into the account. Then he would initially buy the property at foreclosure. So the first step in the process was telling us he's buying a property at foreclosure, get it fixed up. So once he's bought the property, he would send the bills to us. We cut the checks to actually repair the property and paying his contractors. Puts the house back on the market, has his IRA sell the property, get the $10,000 down from his new buyer, and then have that new buyer sign a note and mortgage for the balance of that $70,000 purchase price. Now, our job at Advanta would be to process that initial purchase, make sure that the foreclosure document, the deed, that the foreclosure auction is titled in the name of his IRA, make sure he approved all that up front. When the property was in the IRA and he had repairs, Jim would send us the bills. We would cut checks out of his account to get those paid. That's all included in our annual fee. Ultimately, then, we would process the sale as well, signing off on the documents to transfer the property to the new buyer, and also make sure that the loan documents would come back into they're properly titled in the name of the IRA as well. And again, also making sure Jim approves every step of this particular process. So ultimately what happened with Jim is he got monthly cash flow back into his IRA without having to pay expenses. He was able to acquire property at a good deal, get it fixed up, get it sold, and have a higher performing, higher valued note back into his account. So his note basically was purchased at a discount. Okay? He put out $40,000 for the property, but he ends up holding a note for $70,000 within his account. So the question just came up, I thought you couldn't benefit from a transaction. Why isn't this prohibited? Is Jim buying the property with money from his IRA? Sorry if I didn't make that part clear. Jim is buying the property at foreclosure in the name of his IRA account. So his IRA is actually making the purchase of the real estate from the county at foreclosure. That's certainly legal. And then when he sells the property, he's selling it to a third party. Let's say Tim. Jim's selling the property to Tim. Tim's not disqualified and is buying the property from Jim, so from Jim's IRA. So Jim's IRA was both the buyer of the original property and is also now holding the mortgage. So there's nothing prohibited in there because Jim personally is not involved in that transaction or is not receiving any benefit from that. So I hope I kind of answered that question as well. So it certainly is legal to buy property in the IRA and then sell it to an end user after the fact and hold seller financing as long as the people involved in those transactions are not disqualified. We're coming up on the end of the webinar. I invite you to ask. If you have more questions, please get them typed into the chat box on your screen. If you are participating live, I'd be happy to stay and answer any questions that I can. For anyone who's watching the recording, or if someone who just wants to ask your questions privately, simply call me or email me. My information here is on this last slide. I'd be more than happy to talk with you about more aspects of private lending, or certainly on anything else related to self-direction, whether it's buying real estate, buying rehabs, using a checkbook LLC, as we discussed briefly as well. Please contact me. I'm available anytime, no charge whatsoever for any consultation or questions that you need answered. You can also visit our website at advanceira.com for other upcoming events and seminars that we're going to have, whether it's it's a live webinar, whether it's a live seminar at one of our offices, either in Tampa or Atlanta. Please go there. You'll have all those events listed. You can sign up. All the education we provide is free of charge, whether it's a call to me or whether it's attending one of our events. We'd love to have you and hopefully give you as much education as you need to feel comfortable when self-directing. At this time, I don't see any additional questions that we have, so I'll conclude the webinar. I want to thank everybody for participating live, and also thank everybody for watching the recording. Thank you.